Well, good morning, and we're going through some changing times in America, and for small business, that's always a challenge. And so the four of us are going to chat a little bit about some of the pieces, the levers that you can pull as a small business owner, and that primarily revolving around interest rates, inflation, and credit. And we're going to talk a little more specifically about some of the business challenges that small businesses face when they're looking to finance their business, whether that's a payroll kind of loan that you can kind of float some money through the business, credit cards and the such. And so we're going to go through that a little bit. There's some ups and downs. And in terms of business, why should you use credit as a businessman? Maybe is the first question. And I'll throw that. I'm going to start off with Ed today, just talk a little bit about that. What kind of credit should a small business kind of look for beyond just the personal credit card in their back wallet that they probably start out with, right? They start out with their American Express, and hopefully they can fund their business. But why don't you talk about some kind of traditional ways to look at that before we get into some of the bad news?
Well, the key with credit is that you have to establish credit and you have to get approved for credit when you don't need it. And unfortunately, most people don't try to get credit until they need it. And then when you need it, they throw all kinds of hurdles in front of you that you have to jump over to meet the requirements. So I think what people are experiencing right now, a lot of small businesses, is that they didn't have the right amount of credit. They weren't approved in advance. Now the interest rates have gone up significantly, and now they have to apply for credit. And the banks were more willing to give the credit when the interest rates were lower. It seems that way. It seems like the money supply is a lot tighter now. So the requirements of getting a loan have increased. And we talked about this many times in previous episodes, is that one of the big reasons why businesses go out of business is they don't have enough money to sustain their efforts.
And so, traditionally credit is kind of that thing where you're going to float some bills through that, have some, a little extra for payroll and your receivables are short. I think for businesses that got ahead of it, and like you said, have credit ahead of the time they need credit, it's probably a good thing. But typically we're seeing, credit being used at the last moment, credit card debt specifically, or if you just have kind of a regular line of credit with your bank, it, you know, it's been challenging since COVID, and that's been used a lot. The last, organization we were working with, we ended up with a nice line of credit there ahead of time. We were using between 25 to 50% of that just to roll through, but we were paying it down at regular rates. When it got tight, it got really tight. And then you start worrying about, do we get that credit up to 75%, 80%? How do we pay that down when receivables are now tight? And you end up with a debt bomb, so to speak, for a company. So it's a challenge. Ron, you looked at a couple of more recent numbers. Why don't you go through those about, how our small business is using credit and how do they feel about it?
Well, this was a survey that was done, and it didn't give us all the answers that we would probably like to know. Some of the things that we would really ask, but basically, it was done by NFIB, which is the national small business organization. And basically their particular survey was saying that about 26% of small business owners either tried to borrow or did borrow for business purposes in the last 3 months. So that's relatively current. It doesn't tell us how many got the loans. I think that's the part that we don't really know, which would have been, of course, the critical question. 8% were very satisfied with the amount and the terms, but apparently previously, a year ago, 32% were satisfied. So we might infer from those numbers that a lot less, about 2/3 of the people didn't quite get what they were hoping to get, if in fact they had borrowing experience and they had a relationship with a bank. What Ed had to say is really critical. You've got to get that relationship before you really need it. Otherwise, it's really very, very difficult to get any money. And the number one problem that pops out is of course, we don't, it doesn't even need to be repeated, as 80% of small business owners, they reported high interest rates as their largest complaint. So it's like, duh. And I think that what that does is that brings us to kind of a subject of, well, okay, they're higher. How much higher are they? You see, I come from the old school, back when we were paying 18% interest. Okay, so it's like, hey, you can live with 5% or 7%. But the question is, when should you? And I think that's a difficult, that's a little bit longer conversation. But I think in general, you can kind of say, hey, look, if you're behind on your payments right now and you can't keep up, you want to be very careful about how you borrow the money as to whether or not you're going to be able to pay it back. And there are circumstances where it makes sense. Your business is going along pretty good. You're out of inventory. You've got to, get this next bulk of inventory in order to be in business for the Christmas season. Okay, that's a pretty good reason to borrow the money. You get it turned pretty quick. You pay it back as soon as you can, et cetera. So there are times when borrowing money makes a lot of sense. But if you're just generally slowed down and you're not creating any profit or a very small amount of profit, and you have a pretty good size loan out there, you want to be careful about just continuing to go into the hole all the time. It's very difficult to get out of a deep hole in the small business. Very, very difficult. And the reason is kind of simple. And that is that if you owe a large amount of money and you're paying 5% on that amount of money, say it could be as high as, say, 50% of your annual revenue, maybe. So that's a lot of money. But you're only going to make 5% on your annual revenue. And that means by the time you pay your taxes, you just broke even, roughly. You're barely going to be able to pay the interest on that. And that means you're going to get in the hole further and further and further. So it's really important to think carefully about why you're borrowing. And if you can at all get away with not doing it, you ought to try that. You should do all the cash flow tricks. We have some videos on that you can come up with before you end up borrowing at too high a rate. Having said that, I'll take one more minute just to say, I think that we're getting used to a more normal interest rate. Everybody is in shock. Those of us who are old salts are not in shock because we all paid interest rates that were high. Ray, what was your interest rate on your first house?
Well, that's an interesting story. I moved here in 1980, and we were going to buy a house, and when we started the escrow, it was 11%, and by the time we closed, it was 13.
Yeah, so there
so
you
I
go.
mean, that just added $250 a month to our payment, which was probably outside of our reach, but we did it anyway.
Right. So Ed, how about you?
Pretty similar to what Ray explained.
Okay.
Yeah.
So I was lucky because I had already owned 3 houses by the time the interest rates, started going up. And I had done quite well in the real estate, just in that part of the real estate business. And so I was in at the old rates of 4 or 5%. Sort of like, oh, okay, that's really not too bad. And so, but by the time it caught up in the 80s, our interest rate had gone up, but I only I only had a mortgage on about 30 or 40% of the house at that point. So, it wasn't that crazy, but we literally had friends that were like, at 13%, and their payments, I mean, what would it be? It would be like double or triple the payment, so it really meant that they really couldn't afford it at all. But there was a strange thing going on, and that it's not unlike today. Houses were increasing in value so much that everybody was figuring, I'll get it on the end. And so if I'm paying 12% interest, my house is going to go up by 12%. It's all going to work out okay. Guess what? It didn't work out okay, because we had a recession it wasn't quite as bad as 2008, but the 1980 79, 80, 81 recession in some parts of the country was devastating. And they were foreclosing on apartment buildings, they were foreclosing on individual houses. It was like somebody turned, as a matter of fact, it was so bad in Seattle, they had a big sign, you'll remember this, a big sign that said, "Last person out, please shut off the lights." That's because Boeing wasn't selling anything in those days as well. So it's borrowing can be really nasty if it's done in the wrong way. My point here, and I'm sorry I've gone on too long. My point here is there's a normal interest rate that gravitates around 3 to 6 or 7%. We're just getting back into normal. Now, Ed, what do you think about that statement? What is a normal interest rate?
Boy, I kind of think right now it's anywhere from what 5%, it was 5%, and it's probably gone up to like 8%. I think you should be able to do business in anywhere in that range. It's a lot more modest than what you've been talking about like 50 years ago.
No, I'm talking about, over the 50 years. What's a normal rate over 50, 60, 70 years? It's certainly not 2%. It's
No,
not zero.
it's more like 5 to 7%, somewhere in that neighborhood. But the bottom line is, no matter what it is, you have to be prepared to continue your business and grow your business, which means that you have to have a plan in place. You have to have the resources available to plow back into your business, which means you got to have a credit line. And like we talked about, you got to have that in advance. You can't guarantee that you're going to get it at any point in time. And opportunities come up, you need the cash to seal the deal. And if you don't have the cash, you're going to miss out on a lot of opportunities to grow your business.
No. Of course, the small businesses we're talking about, they start with not very much. Maybe they borrow a little bit from their family or whatever, but maybe they got a couple of partners. They don't have all that much money, but they don't actually think about how they're going to grow. They don't think about, do they need money? What would the interest rates be? And build a financial model, as you're mentioning, to be able to determine if they need money or if they don't need money. Most people just assume that they're going to grow because they're going to have retained earnings that will fund everything that they're doing. And I have yet to find anybody that's growing more than 5 or 6 or 7% that can fund based on free cash flow. You don't run into them very often. So small business people tend to think that you just get started and it's just going to work because they're just going to make it work. And that's why bankruptcies,
Yeah,
are pretty high.
I think most small businesses don't spend enough time analyzing their working capital. And I've talked about that several times in the past. And what ends up happening if everything starts changing. So let's say your vendors, instead of, they used to give you 30 days credit, now they want a deposit or they want half their money up front. Okay, that changes your working capital significantly because now you got to have more money to do business. And then the other thing is, I think most businesses don't really spend the time that they need to optimize their receivables. They don't spend enough time making sure they're getting their money in a timely manner. And the sooner you get your money, you're going to have a significant improvement in your working capital, and that will make borrowing from the outside very minimal because you won't need as much money. And I think that's one of the problems. Everybody focuses on their income statement because they kind of understand it. You got to make a profit. You got your revenue, you got your fixed expenses, you got your variable expenses, but they don't want to spend the time analyzing their inventory levels, their accounts receivable balances, and they don't want to optimize their payables. So I think that's a real challenge for small business. And unfortunately, very few of them really focus on the balance sheet. They just don't understand it. They focus all their time on the income statement.
Well, I was going to add real quick, and I'll circle back a little bit. Total credit card debt in the U.S. hit $1.08 trillion. That's the highest ever. It went up 150 billion last year. So that's a growth of 15% of use of credit card debt. And that current credit card, according to the Bank of New York or the Federal Reserve in New York, is 22.77. The challenge there is that, that a lot of the consumer spending habits have driven sales, but they've been driving sales at that plus 22%. And one of the big problems, and maybe this isn't taught in regular education before you get out of high school, is that, a lot of the Gen Zs and Gen Millennials are just going to abandon that debt. They're currently doom spending. They're predicting 1 in 4 people are not going to ever pay back that debt they put on the credit card. So think of people doing that, and then you get to the next level of a small business and into a mature business. I'm not sure that understanding that has really worked, but I think one of the things we saw that is just maybe the hardest thing to deal with, and you mentioned it, Ed, receivables. The gorillas in the room are generally your big clients, your 80/20s.
Yeah.
And the gorillas in the room are taking your money from you by stretching from 30 to 45 to 60. And, that is a credit issue. And that you as the unknowing small business owner have just given credit away to you become the bank. And
Right. They bribed you with the volume that they give you.
yeah, in our manufacturing situation we were last in, the 2 gorillas in the room, one of them paid 3 days. And then you knew stuff was getting tough because they started paying at 10 and then 20 and then 30. They hit it at the 30. But the other gorilla was just always like, well, shoot, we'll push it a little past. You're not going to do anything. We'll go 45 and 60. So talk a little bit about how credit is on the business side in a lot of cases, not just the bank giving you credit or a credit card, but you're accidentally assuming those terms, right? You signed it on the contract. So talk a little bit about that.
So you're talking primarily about credit cards,
No,
John?
just some receivables.
Business trade
Oh,
credit.
receive-
Yeah,
Ah.
trade credit is the issue. Yeah.
I go to places where they don't even have an age receivable listing. And there's no focus on collecting.
Yeah.
They get low on cash and they start calling people. But when you're running a business, you got to get your funds as soon as possible every month. So you have that money to operate with. And so you have to have policies and procedures in place, and you gotta know which customers you want to work with and which ones you don't. And there are some customers that demand absolutely the smallest return of profit for you, and they're going to extend you out forever before you get your money. And quite frankly, you can't afford customers like that.
Yeah. Especially if you are extending trade credit and you have to borrow the money. If you're working on a 5% margin and then you're paying the bank 5%, it's like, whoa, we're just turning dollars with that particular account. That
Well,
makes sense.
I think one of the things that you've just kind of identified here is that it's the primary reason that 80% of new businesses go out of business is because they really don't understand the money side. And as a consequence, they get overstretched and, they can't do it, and credit cards only take you so far. And the person who's getting your services really doesn't care, they'll extend you out to 90 days in a heartbeat.
Yeah.
Well, and then on the other side of that, your supply trade credit, when you're buying supplies, if you haven't built those relationships, paid on time, gotten the better terms with your suppliers, now you get this stretched purchasing, production, sales, receivables deadline that could go 120 days before you get your money. So now you're using your credit at your 5%, hopefully, maybe 7%. Over say 120 days to return that, and what does that really mean?
I think one of the additional things that the return of interest levels back to normal, I'll say, but they feel high right now to most small business people who haven't experienced it. But I think you have to kind of look at things differently. You need to increase or change the thresholds of when you're going to make that kind of an investment where you have to borrow the money, because some deals will work at 3% cost of money, and other deals won't, and therefore they won't work at 5 or 6%. So you have to be willing to go, what, this deal doesn't work anymore. You have to go through that scenario a little bit and say, we're not going to borrow money for any purpose. We're going to borrow it for things that make sense. So, you apply that to, say, buying a new piece of machinery. If you are going to buy that on time, maybe either from the vendor who gives you the financing, or you go to a bank who gives you, some financing, in your return on investment, it ought to be really very high. It ought to be a return in, 5 years would be a goal, but 8 years somewhere in there, maybe it's 10 or 12 years. But if you are paying a 7 or 8% interest, suddenly your payback time increases. And you kind of have to be willing to go, we know where our threshold is. We're not going to borrow the money at that interest rate for that particular investment. Let's look for another one, either better terms, a different machine. Maybe you don't grow. Maybe you decide to hang in there a little bit, but some businesses will not work if they're paying 7 or 8%, depending on the need for capital. They just won't work. It's one thing to be in a restaurant where you just have to, come up with your food bill, which is about a third of your revenue. And then you got to pay your sales, your people, and you're paying them every week or every 2 weeks. That's entirely different business than a retail business where you're going to own 25% at least of your inventory. And therefore you need to own it outright, or you're going to have enough markup and enough net profit on that business to be able to pay the higher interest rates. If the interest rate's 2-3%, it's not so hard to deal. Make that thing work. But if your interest rate is 7 or 8%, it's amazing how it becomes unprofitable simply because you borrowed money to do that. That's not an exercise that most small business people are comfortable with. That's not an exercise that I've only rarely heard people who are big businesses. I'm talking about those that have got 20 to 50, 100 employees. Rarely businesses that size will actually get into that level of detail, run through a spreadsheet, and actually take a concerted effort to make that kind of an informed decision. That's the level of non-sophistication that our small businesses have. So in these turbulent times with interest rates going up, we shouldn't be surprised that the bankruptcy is up 29%.
No,
We should have expected that, absolutely. The
absolutely.
unfortunate thing is that those are real people who used to have real lives, who are maybe losing their homes and their cars, and they're certainly losing their businesses. And it affects them for many years to come in order to be able to repair all of the damage that it has done to their reputation, to their credit rating. It's really a tough situation. So I guess what we're saying is that you need to model your business. You need to understand the cost, the increased cost of interest rates, and you need to be very rational about it.
Well, I think this is probably a good time to end. I think the conversation probably went full course. Maybe next time we can have this conversation with some spreadsheets and have a couple examples of cash flow in terms of the challenges of basic things. I know cash flow is a really complicated thing, but if we were to show a couple examples of a manufacturer that has to purchase, hold, produce, sell when they get that money, I think that would be helpful, as opposed to, restaurants where they have a quicker, they really shrink that down. You're getting your credit card payments in your bank within a few days now. You're not waiting too long. There's a lot of online tools out there to help you receive monies quicker, and we could look at some of those. But I thought this was a good conversation.
Yeah, I think so too. I think one of the elephants in the room that you alluded to, Ron, was how many people start a business and use their home as collateral and then end up losing their home. That's really one of the things that, we can talk about in more detail.
Yeah,
Sure.
Yeah. All right. Thank you. We'll
Very
see you all next
Yeah,
week.
good day, good conversation. Thank you, John.
Thank you.